All right. Back again. Question and answer with your favorite mortgage broker, Matt the Mortgage Guy, live every Monday at 6 p.m. Pacific Standard Time. I go as long as we've got questions flowing up to about 2 hours. And so I've got 2 hours blocked tonight. Man, time flies. It seems like only yesterday. We were talking last week, and it seems like only a few minutes ago I woke up and got rolling. Things are busy in my business. Things are busy in the real estate market. So I'm excited to jump into wherever the conversation may lead, whether it's you want to know questions about your specific scenario, the market as a whole, whatever it is. Inevitably, we just take whatever path you folks give us as far as what kind of questions you want answered. And had a bunch of interesting conversations today, as I always do, with buyers, with real estate agents. If any of you follow Jason Walter on YouTube, if you don't, check him out. He's a Sacramento real estate agent, and he got about 20,000 subscribers because he puts out really good information on stats, had a lot of good updates on forbearance and foreclosure and all the different stats that come out of National Association of Realtors and whatnot. So had an hour-long conversation with him on Wednesday on his channel, I think is when that's going to come out. But it's always for me great whenever I get to talk to somebody who's an active professional following the market. It's just always good conversation, right? And so me and him had a great one today. Looking forward to getting some feedback from folks on his channel as to where that conversation went. So, all right. I know, Jennifer, I saw you in the comments before. Market's getting better. And by better, you mean less competitive. Me and Jason talked about that. I feel it. I had a record week last week. I don't know when the last time I submitted 12 loans in 1 week was, but last week was one of them, right? And it was either 12 or 13. And it's just a sign, right, that it's getting a little bit easier to get your offers accepted. It doesn't necessarily mean that it's going to be a piece of cake. And as buyers, you're going to get to go out there and, submit an offer at ask and get it accepted. But if it's getting a little bit easier, if the summer months are bringing more inventory, or it feels like there's more inventory because stuff is selling a little less fast, and buyer demand, albeit subtle, is coming down a little bit because people are going on vacation. People have been locked in their houses for 15 or 16 months. They take the mask off. They breathe easy. They're free. They just get out there and start exploring this beautiful country of ours. Maybe, just maybe, we're going to have an easier time getting offers accepted. So yeah, I appreciate the feedback, Jennifer, from you and anybody else across the country on what they're seeing across the country. In response to you, Jose, what's the word? Refi. I tried to tell people last Monday and the Monday before, I feel uneasy. I feel like there's something a-brewing. There's something coming to rates. And if you aren't tuned in, dialed in, listening to what's going on, last Wednesday, the Fed didn't do anything as far as moving up the Fed's fund rate. They just talking about moving it up. And some of their predictions, some of their dot plots, some of that moved from 2024 to, maybe in 2023, we'll tick it up. And just that alone, that discussion. And then I think Bullard is somebody on the Fed who said he thinks that they're going to move it up as early as 2022, which, by the way, is next year. Those conversations about how early the Fed is going to stop suppressing mortgage interest rates and raise the Fed funds rate, stop buying mortgage-backed securities, let rates go a little bit. That conversation led to a tick up in rates. Rates got worse Wednesday and Thursday. So, nothing ridiculous, but, if you were looking at something last Monday and then I talked to you today and it's a quarter worse, try to tell you, if you like it, lock it. Let's get it rolling. So some people listen, some people don't. Still, there's so many people that have mortgage insurance, have a 4% rate that can benefit from refi. So reach out. I'm lost for words on some scenarios where people just, whether it's $10 a day and they're going to save $300 a month, or it's $13 a day, they're going to save $400 a month. Every day you wake up, it's a new $10 bill being burned in ashes, extra interest you're paying that you don't necessarily need to. I mean, unless you want to support some of these big banks, big servicers, big lenders by paying more interest. Take a look. Joey, appreciate you being here again. Kind words. Mona, another loyal follower. Thanks for joining tonight. Looking forward to having some good conversations on the market. We can talk about rates. We can talk about the market. Let's see what you got here, Joey. I believe you've discussed this one in one of your videos. What's the skinny on B of A's affordable loan solution or other no PMI loan down payment mortgages? This is a great question, Joey. And it's funny because marketing is great. I mean, I applaud marketers. I'm a fan of marketing, but when you're marketing and it's somewhat deceptive, I just think that's not too cool. So anybody who has seen an ad where somebody says, we got a loan with no PMI, put 3% down, no PMI, 5% down, no PMI, come on down. If you think it's a special program, if you think it's something that only they offer, it's not. And I'll tell you in real simple terms how it works. If you've got a 3% and I tell you that based on your credit score, I can get you a 3% mortgage, 3% down, and let's call the rate 3.1%. I'm calling it that because I don't want to call it 3 and get you confused. 3% down, 3.1% interest rate on a 30-year fixed, and you've got mortgage insurance of $225 a month. If you're marketing this affordable loan solution, you might say, hey, we got 3% down, no mortgage insurance. Awesome, man. Sign me up. Okay, you're putting 3% down. You've got a 3.75% interest rate, no mortgage insurance. What just happened? Instead of paying 3.1 and mortgage insurance, you're paying 3.75, no mortgage insurance. Essentially the same payment. It's lender paid mortgage insurance, and it's basically baking in the PMI to the rate. And it's not quite that apples to apples and simple, but that's the idea, right? Is that you're never going to have 3%, 3% down, 3.1%, no mortgage insurance in place of a different loan that has a $225 mortgage insurance attached to it. They're going to get you somewhere. And if they're doing some sort of lender paid mortgage insurance, you can also do an upfront version, or maybe you pay $6,000 upfront, which I wouldn't advise because you don't know how long you're going to stay in that loan, and you might save $225 a month. But if you refinance 18 months later, that opportunity cost, that $6,000 you spent up front, is gone forever, right? And so it's a creative way to market, and that's about it. Jennifer Sabino, how high is FHA interest rate now? You should have said how low. There's nothing about FHA rates that are high. This is credit dependent, and like if you've got perfect credit, it's probably in the mid 2s. If you've got not so great credit, it's probably closer to 3. FHA, I mean, in my personal business and for what I'm seeing, there's just not a lot of people buying with FHA. Refinance with FHA is really uncommon because generally you're refinancing out of mortgage insurance. And so very few FHA refinances. But on a purchase too, it's relatively hard to get your offer accepted with FHA right now. So I would say across the board, it's probably like less than 5% of business. Let me see. Purchase, my zip code, 3.5% down, FHA, just so I can get you an idea. And generally, like if you're 660 or lower on credit score, that's where FHA is going to make the most sense. Sometimes FHA you do because they're a little bit more flexible on debt to income ratio. So maybe you only qualify for 350 conventional with 3% down. But if you did FHA, you'd be able to go up to 380 because they're a little bit more flexible. The rate's a little bit lower. But let's see, FHA. Yeah, I was right. About 2.5% without paying any points. Another reason you might use FHA is if you're really short on funds, we could do this same FHA loan. Instead of taking 2.5%, we take a 3%. I'm looking at my rate sheet right now. We can give you like $6,000 in credit at that 3%. So take the 6,000 in credit, cover a good portion of your closing costs, and only 3.5% down is what you're going to come with, plus maybe a few extra thousand in closing costs. So it's a way to get in there with less down payment sometimes. So those are some options for FHA. Music Lover 78, how you doing? Do you think 7720 origination charges are too high? Well, this depends, because origination charges are a factor of a couple things, credit score, loan to value. If you're paying 7720 in origination charges, but your rate is 2.5 on a conventional loan, and it's a $700,000 loan, then maybe that's a great deal. If it's a $200,000 loan and the rate isn't so great, and you've got a 7720 in origination charges, that's a lot. This sounds high, but without the full context, I wouldn't be able to say for sure, because on a $500,000 loan with an outstanding rate, or maybe it's an investment property, it might not be too terrible. So yeah, give me all the rest of the deets. Kevin, good evening to you, sir. Got your email for Happy Father's Day. I appreciate you, man. Thanks for joining. Thanks for being a Matt the Mortgage Guy loyalist. Raving fan. All right, New Jersey. You told me it's getting a little bit easier. I like to hear it. All right, Zeta, I was asked for my answer for the end of the year for 2021. So I'll give that answer here, because I did it with Jason Walter today on the video we recorded for his channel. It'll come out Wednesday. Between 3.5 and 3.75, end of 2021. That's my story. I'm sticking to it. We're sponsored tonight by Jocko, his Real Energy drink, which is zero sugar, bunch of vitamins. If you don't know Jocko Willink, he wrote some books. He's got a podcast. He's a U.S. Navy SEAL. I'm just kidding. It's not sponsored by him, but if I'm going to drink something to give me a little bit of energy, it's not going to be sugar. It's going to be some good stuff. All right. If I have to Venmo someone, paying them back, and it's connected to my bank account, will this affect my loan? It shouldn't affect your loan in that, let's say you've got $22,000 in your bank account. You need $17,000 to close. If you're paying someone back $400 because they let you borrow it for whatever reason, and you don't need that money for closing, then you're completely fine. And I wouldn't worry about it. If you're paying somebody back $7,000, and so your bank account's going to go down to 14 and you need 15,000 to close, then you're in trouble, right? So as long as it's not going to affect that, then you're fine. Because a lot of people get really good advice. Don't do anything in, out, sideways with your bank account. Don't take in cash. Don't do big transfers. Don't do anything that's going to be red flag-ish. But this is something that would be fine. And I appreciate you asking. Whenever I get a client who's like, this may be a silly question, but I wanted to ask, it's good. It's good to be cautious, right? Because you're in a transaction to buy property for hundreds of thousands of dollars. You don't want to screw it up. So yeah, quick answers. I think you'll be fine as long as it's small and it's not the funds you need to close. Following up with Music Lover, 2.99 conventional fixed refinance. When you say origination charges, you're talking about box A on your loan estimate. If there's no credit and it's just 7720 in origination charges, you're probably, that's probably expensive. That's a lot. If you tell me you went to a company like Quicken, I'm not surprised. And 7720 sounds like them. If you're talking to a local mortgage broker, probably get a better deal. Let me know what state you're in. Might be able to hook you up with a mortgage broker to save you some money, because that does sound high. I guess depending on your credit score too. 404 remaining balance, and you said it was 7,700 in charges. That's pert near 2 points. That's expensive. That's too much. Unique one. That's a unique handle. Is it hard to get a VA pre-approval? No, I mean, it's not any harder than, other government loans, like an FHA loan. They're going to look at, your income, your credit score, and obviously your VA eligibility. We're going to pull, eligibility to make sure that you're eligible for the VA loan, but, it's actually a little bit easier. The debt to income ratios go a little bit higher than conventional loans, than even FHA loans in a lot of cases. So, not hard to get as long as you got verifiable income and decent credit. Simon, what's up, my dude? How you doing? This guy, he's already thinking about property number 2, hasn't even closed on number 1. That's my type of dude. If you're buying the first one as a primary, aren't you using a non-QM loan? I thought you were using some sort of non-QM. And in that case, you wouldn't if this is a separate deal, this is a primary residence, more often than not, you're signing something that says, I intend to occupy this property for 12 months. And what I will tell you off the record, besides the fact that this is recorded and on YouTube, is that I know sometimes things change. 9 months down the road, 10 months down the road, you decide, I want to move closer to the school that my future kids are going to go to. I want to move closer to my mom. I want to move closer to my aunt. I want to move into something that's a little bit roomier. It's got a little bit more space. I want to move something that's bigger on a bigger lot, whatever the case may be. If you did that, there wouldn't be any repercussions. You wouldn't get, fined or the loan called due because you moved out 10 months later. So hopefully that answers that question. Rana, in the loan documents that I signed, there was an anti-steering document that said I had lower options available to me that the loan officer is supposed to disclose to me. This is a really common disclosure. And I'm going to defend your loan officer in this case, because they basically have to show you on that anti-steering the lowest rate possible and the highest. And so let's say that you got a 3.125. You didn't pay any points for it, and you just did a cash out refinance. That rate sheet probably goes down to 2%, and it probably goes up to mid 3s, maybe even 4. So at 4%, you could have got a $6,000 credit. At 2%, you would have had to pay $29,000 in points. Now, you can probably answer this question for me. Would you ever pay $29,000 upfront for a 2% rate? I'll answer it for you. No. And so the idea of this is like, hey, just in case it wasn't presented to you, let's make sure you could have got 2% for $29,000. Truth be told, I'm running different stuff by my clients, and I'm saying it looks like this is the best interest rate for your scenario. It's not even close to fathomable or reasonable for you to pay $29,000, $36,000 to get that lowest rate. And so I would not hold it to them like, hey, you're supposed to disclose this to me, just in case I want to make a really bad financial decision and pay $30,000 up front to lower my payment by $130. That's what that disclosure is. I may have an extra $5,000 to put towards my home purchase. Do I A, put it towards appraisal gap, B, bump down payment from 3.5 to 5%, or C, keep things the same and add it towards closing? 100%. I think you add it towards the appraisal gap. Write that in your contract. You might not need it, right? But write it in the contract, because in my opinion, that's more important than anything, is giving the seller some comfort in that if this thing comes in light, I'm willing to pay above the appraised value. $5,000, $10,000, $20,000. In a lot of markets in California, it's 30, 40, 50, no appraisal contingency at all. And like I talked about with Jason Walter today on our talk, was a lot of times you're having to waive the appraisal contingency altogether to be in the running, like it or not. That's in my market, Northern California. Other markets, maybe not, but in my market, that's almost the price of admission to be considered. Those that have an appraisal contingency, or only up to 20,000 above, only up to 25,000 above, depending on the price point. It's different. If you're paying 25,000 above at the 400 price point, you're maybe cool. But anyhow, my answer is A. And The reason why I don't choose B is because that extra down payment is going to have such a small effect. You'll see, and if your loan officer would put them side by side, you put an extra $5,000 towards a purchase, it's probably $25 a month in payment. And I can tell you with certainty, you're going to want $5,000 in the bank. If you don't have to make the appraisal gap and you get to keep the $5,000 and you don't have to use it towards the that gap, hold on to it. $5,000 in the bank is way more valuable than $25 a month to most people. I mean, that's what, 200 months of break even. And really, like, if you're putting 3.5% down and money is any issue at all, having some reserves is a good idea. As a homeowner, it's not all sunshine and rainbows, puppy dogs and cotton candy. There's going to be a hot water heater that breaks. There's going to be some dry rot you need to fix. Maybe a leaky AC needs some repair. So it's beautiful long-term investment, but it might cost you something here and there. So keep that $5,000 in the bank. That is my best advice. All right. Who is it, music lover? Don't be shy. It's not Quicken. My second guess is direct lender. Fairway Mortgage. And tell me what state you're in. See if I can't hook you up. I mean, I guess if you're looking at a refinance, just run it by a second person. I mean, shoot, you can email it to me if you want. Email me the whole kit and caboodle. Tell me what your credit score is. I'll tell you thumbs up or thumbs down. If it's out of my state, obviously I can't. I'm not trying to steal a loan. I'm just trying to give you some good advice. But for being here, for following the channel, it's the kind of service I provide. Matt@mattthemortgageguy.com. Send it over, music lover. You're welcome, Unique. You're welcome, Rana. Here to help. That's why we're doing this. What's up from Florida? Just cruising, mom. I recognize that name from the YouTube comments. I appreciate you and your support, following along, always chiming in. That's what I'm going to try to do more of is on the YouTube videos I'm making. I want some feedback. I want people in the comments to discuss what's going on in their market. I think it helps everybody, right? When somebody who's going through something, whether they're trying to figure out how to make their offer stand out, how to get an offer accepted, they're thinking about should I refinance or not. You start seeing comments, and I'm not all knowing, right? I've seen a few mortgages, so I like to think that I know a thing or two, but people from all over the country who are going through similar stuff, they've got some good stuff to add. So I'm going to start making it a habit to ask for people that leave more comments. I already get a lot of comments. I need some more. Yeah, I feel you. Phoenix, Arizona was one of the top 3. What was it? Phoenix, Arizona, Seattle, and San Diego. Those were the top 3 markets for appreciation, like either year over year or 2020. I've seen so much stats. They all just blend together, but Phoenix is up there where it's hot, literally, and real estate marketly. That's a word. There's some good brokers in Florida. So let me know. Let me know if you need connecting. Happy to help. Offer accepted list price. Congrats. What? Oh, MD. That's Maryland, right? What? In the last 6 months, homes have gone from 254. There's no way that you guys have seen 80% price appreciation in 6 months, but maybe it seems like that. That would be I mean, that is crazy. John Brown. Where'd he go? Oh, there it is. Any loan programs is doing 5% down on a multifamily, not FHA. If you're trying to do a low down payment on a multifamily, you are only going to be able to do FHA. I had a couple other folks that joined and we chatted, and there used to be Home Possible, Home Ready, multifamily conventional stuff where you could put 5% down on a multifamily. That went away. And so the 2 unit, if you occupy, man, I'm going to get this wrong. I'm going to do this. Instead of giving you guys bad information, I'm going to actually, I swear I did this too, like not that long ago. 2 unit. If you live in it, I want to say you might be able to put 15% down. Stand by. This is my old trick. You price it, and if the pricing comes up, then you're good. If pricing doesn't come up, then no go. So I know on 3 and 4 units, you got to put 25% down. I'm almost positive. 2 unit owner occ. Let's see if you can do 15%. Yep. You can do 15% if you're going to owner occupy it on a 2 unit. Let's see when I go 3. When I go 3, if you owner occ, maybe you could put 20. Oh, Home Possible will let you do 15 on a 3 to 4. You could do Home Possible or a regular FHA on a 2 unit. 15% down. So basically, yeah, 15% if you're doing conventional, 3.5% if you're doing FHA. If you're trying to get in there for low down payment, FHA is really kind of the one. It's got its drawbacks. It's got mortgage insurance and whatnot, but it's super low interest rate. So it's, especially you're 22 years old, don't own anything, and you can get into a multifamily at a decent price. It's essentially house hacking. Then you're doing good. You talking to me? Where'd I get my haircut? It's nice, huh? There's a place. I live over by Sac State, and so there's a place on Folsom Boulevard called Expert Cuts, and it might be out of your price range, Ryan. It's $9.99. Looking good, huh? I'm telling you, these guys know what they're doing. I am far from fancy. So I get $9.99 haircuts, and they're money. I'm pretty sure it's called Expert Cuts on Folsom Boulevard. So yeah, either you liked it and you're asking for that, or you're clowning me. Either way, love you, man. I love the stuff you're doing. Special shout out to SacramentoAppraisalblog.com. It's good stuff. I was just on there today. I was reading article about hedge funds buying homes, and that's a fun subject for folks, Ryan. So thanks for putting that out there. If anybody who doesn't know, SacramentoAppraisalblog.com, check it out. It's got good stuff. Only 2 homes in your county. Wow, that's a serious lack of inventory. What county is that? I know you're in Florida, but 600 to 680, 13% in the last 6 months. That's crazy. I wonder, is this median or average sales price? Raghavendra. It's crazy. I really feel though we got a little summer slowdown. It's coming. I'm just going to speak it into existence. I've had more people get into contract these last 2 weeks than probably April and May. Probably doubled the amount, right? Like these last 2 weeks are probably been equal to what I saw get into contract in May. So I think that's a good sign, just based on my little, business and what I'm seeing. All right. Got my pre-approval based on 610 credit score, paid off all credit card debt and collections, and now my credit average is 675. Pre-approval expires on the 31st. If you're not already in contract, then the pre-approval can be adjusted, improved, changed at any time. And so for sure, you're going to get light years light years better terms at 675 than you got at 610. From 600 to 620, that bucket terms are not that great. 620 to 640, they get a little bit better. 640 is kind of a magic number for mortgage terms, in my opinion. So the fact that you've got to 675, congratulations. You've done a ton of work paying off credit card debt and all that. You basically just want to go back to the lender. Pre-approval is not something where you're pre-approved and I just take this package that I have for you and I submit it to the lender and off you go. And it's like a fixed thing, right? A pre-approval is us reviewing everything and saying, based on the information we have, we can help you buy a house that costs up to $350,000 with 3.5% down. When your credit changes, when you have a bigger down payment because you got gift funds coming or anything changes about your scenario, all we do is make those changes and then update your pre-approval. So in this case, if you were a client of mine and you said, hey, Matt, my credit has improved greatly. If you're actively looking and submitting offers on houses, I would re-pull your credit and say, good news. At the 610 credit score, we were talking about a 3.25% on an FHA loan. At 675, I can get you a 2.6% on an FHA loan. And these are just numbers, not offer to lend, NMLS number 1088993. So hearing all that, that's all you have to do is tell your lender, my credit has improved. If you're not actively looking at houses, I might give it a little bit more time to actually hit your credit report, the stuff that you've paid off and whatnot, because it might not have hit it. And Credit Karma might say something, online things might say something where it hasn't truly, updated on your credit score. So Equifax, Experian, TransUnion, your mortgage credit pull that the mortgage lender is going to do. I would hold off if you're not actively looking. But if you're actively looking, you're like submitting offers this week, next week, the week after, have them re-pull your credit and give you an updated maybe scenario or estimate. Most lenders, I hope, are doing that. I'd be able to, I would be stoked. You call me and you're my client, I'd be like, sweet. I'm able to offer you better terms. I'm excited for you. Better terms means that you definitely have more buying power. Whether you want to use it or not is up to you. But if you were approved for 350 at that 3.2% rate or whatever it was, and now I can get you 2.6 because your credit is better, you could go to 385 or somewhere in that range. I'm just making up numbers, but just to kind of prove a point, that is what I would do. And really, honestly, if you were in contract and this happened, you could pull a new credit report and update it because you're not stuck with, certainly not on a pre-approval. You're not stuck with we pulled a 610 when we originally did it. And so we're using that April 28th credit report and you're just, that's what you got. That's what we approved you on. That's just not how it works. So good job to you. Good luck to you. If there's any follow-up questions, feel free to reach out. I'm happy to help. All right, Ryan, some good stats here. Sacramento region, 485 in January to 560 in May. So what's that? That's 50. That's about 13 or 14%, right? Holy crap, dude. Preliminary median for June is 580 to 585. 485 times 1.15. Holy, 485 times 1.2. That's like a 20% increase in the median from January to June. That's not even 6 months. It's 5 months. A 20% increase to the median price in 5 months. Here's what I'm going to say, Ryan, because I had this conversation with Jason Walter earlier today. What surprises me more than some other things, and you'll have my back here because you understand the difference between median and average, is that I guarantee you this is a reflection of more sales that are more expensive, more $1 million homes being sold. And from what I've seen, you used to be able to segment and say entry-level homes, 350 to 550, really hot, super impacted by tons of demand. And these things are selling super fast. Then 550 to 800, a little bit less demand, not as many people could qualify. And then 800 plus, there's only a small number of people that qualify. That was the old way. Now There's so much demand and so many people buying above $1 million. And the way I explain it, and the way that I think about it, is this K-shaped recovery that we've seen, where your servers, your bussers, your entry-level jobs really took a hit during COVID. People that were well off tended to have, I don't know what the right term for it is, but they got more rich during COVID. Some of their businesses were more successful. Their assets, their stock portfolios, everything went up in value. They're better off than they were pre-COVID. And that's why it's a K-shaped recovery, where it's like some people are doing really well, some people are doing really bad. It's sad to see, but it's the truth. And that's why in regions like Sacramento, you can't explain it. It's just like migration from the Bay Area, and they're buying up all the $1 million houses. Ryan will attest to the fact that like the data doesn't show that. But there's more people buying at $1 million plus because there's more people at that price point that are doing really well and able to go from a $700,000 house to a $1.2 million house. Or they bought a house for $650,000 that went up to $900,000 in 3 years. And so they're going to sell that, take $300,000 in equity, and buy the house they really want. That's 1.2. That's closer to the school they want to send their kids to, or whatever it is. So that's my thoughts on that. That's crazy. 20% in 5 months is wild. Correct me if I made any mistakes there with my analysis, Ryan, but that's just off the dome. Some of my thought process there. Unique one. My aunt is a veteran and I'm a veteran spouse. So what you're asking is you could be on the same VA loan and like combine your, what do they call it? Eligibility. I would talk to a lender. You might not need to. You might have plenty of eligibility on your own. And if you do, there'd be no reason. Are you guys both going to occupy it? The truth is I don't know the answer. But my backup answer is if you don't need it, then just see what kind of eligibility either one of you has individually. And maybe that's would you buy it. But you got to own or occupy when you're using a VA loan. So I don't know if you guys are planning on moving in together. Follow up with me or with another loan officer to get the answer to whether or not you can combine. I don't think you can. That's my gut. Where in the heck do you feel your market is going? We are starting to see pre-foreclosures, short sales, and foreclosures in the county that I live next to. That's interesting to see. In a market as hot as yours that's seen appreciation through the roof, who the heck is foreclosing? Not people that are leaving forbearance. They're getting loan modifications. They've got 30% equity in their homes. So I'd be interested to know what county that is and if there truly is like a big uptick in foreclosures, because the data nationwide doesn't show a big uptick in foreclosures. There's going to be a natural uptick when it's like we've sidelined foreclosures for so long with the moratoriums, the eviction moratoriums and the foreclosure moratoriums. But yeah, it'll be interesting to see. All right, just delisted my home because I keep getting outbid to buy a new home. This is a tough question because here's the thing, Johnny. I'm sure you can sell your house as quick as you want if it's priced right and it shows well. But the problem is finding the replacement. So depending on where you're at, what price range you're looking at, if it was me, from what I've seen, I would just list your home and make it contingent on you finding a replacement property. That's plenty common. And, the truth of the matter is you're not going to move if you don't find a replacement, but somebody who's out there submitting offers, getting outbid, they're happy to get an offer accepted, even if it's an offer that you accept that says, this only is a deal. You're only able to buy my house if I find a replacement. And then, it might be a 30-day, 45-day window where you can find a replacement and they're going to give you some free rent back while you do that. So that's what I would do, because I don't think it's going to if it gets easier for you, there's going to be less competition to buy your house as well. So it's like whether the market gets hotter or less hot or stays the same, you're in the same position since you're selling and you're buying. So you're not at any real advantage. Like you wait, things cool off. All right, cool. Easier to find a replacement home, but also harder to sell your house. Or if, demand ramps up and it gets harder, then you're having an easier time selling your house, but a harder time buying forward, which is what you're dealing with now. So I'd list it and just make it contingent on finding a replacement, because that's really what you're struggling with. And as a seller, you get to call the shots. So you can say that and do that. All right. Who's checked on the likes? Anybody checked on the likes for me? We're up to 42 concurrent viewers. We got to have at least 25 likes. Where are we at? I'm going to click on it. I'm going to try to not get any feedback here. Oh, there we go. See, it clicked up right when I say it. Bam. Now we're in the 20s. All right. I check on you guys. If I don't ask, then, closed mouths don't get fed. Hit the like button, whatever it does. I don't know if it does anything. I don't know if I really care. Makes me feel really good inside. All right, Tyrone, to your question. I just signed a commitment letter. Before closing, the lender will do a soft pull to see additional debt. I had a collection for medical go on my credit report. Will that affect the loan? I don't think so. I mean, in general, lenders are disregarding collections on medical because so many of them are erroneous. Is that a word? Like incorrect? And so I've never seen this pop up. I've seen it pop up where you bought a boat. We're like, hey, bro, what'd you do? What'd you buy? But that's not even going to be an issue. Not gonna be a problem. Very nice. They left a lot of layering. What'd I miss? Layering. Martin County, next to Palm Beach County. 2 homes under $400K without insane HOAs that charge $1,500 to $5K a month. What? That's an expensive HOA. Not something I would want to invest in. Richard, this is amazing. You know what's great about this question is I have not got this question in a long time. When I was working in direct lending, our software only had room for 6 applicants. And we had a loan where we had to manually put in the 7th applicant. So we had, I think it was a couple, either 2 or 3 people living there. I don't know how many people live there and how many were non-occupying co-borrowers, but I've had 7 on a loan before. I don't know if things have changed, but I don't know if there's a limit on how many people you can have on one loan. I mean, some people, it's a family affair, right? Everyone's going to be a co-signer on this bad boy. How many applicants can be on one loan? This is a great question. How many applicants? I've seen 7 personally. How many applicants? You guys know why I do this live every Monday? So I can learn stuff. I'm going to learn something new. And I'm going to report back to you somehow, Richard. Maybe get back on here next Monday and ask me again. Hopefully by then I'll have an answer. Vente. Where did I see you? Did I see you in the YouTube comments somewhere? This name looks familiar. I'm purchasing a new home and it should be completed by September. I'm coming in 5% conventional. The home should have appraised, plus I'm purchasing a few options. How can I use this to my advantage to get rid of PMI? This is a really, really common question. To get rid of PMI faster. Okay. Because some people are like, hey, I'm buying this house and, by the time it closes, they're going to be selling the same model for $720. I bought it for $620. I should be able to get the loan without PMI. PMI is going to be based on how much you put down on the purchase price. So you buy it at $600, you put 5% down. If it appraises at $9 million, you're still paying PMI. But to get rid of PMI faster, if you're in a market that's going bananas, if you bought it, below market value, whatever the case may be, 6 months later, you could refinance it. If it's actually going to appraise and have 20% equity, then boom, PMI is gone. What you have to watch out for the scenario where you just want to remove PMI and have it drop off automatically, a lot of lenders are going to have it written in where you have to have that PMI for at least 2 years. And so even if there's comps, and even if you get to the end of a new build sale, and you say, look, everything around me is selling for 725 and I only owe 582. You should be able to, remove this mortgage insurance. And that might not be 80%. That was just a shot in the dark. But it's worth 750 and I owe 582. Remove the PMI. If they've got something in there where you got to have the PMI for at least 2 years, then you're, at least 24 months of paying it before you can even go through one of their different options for asking for it to be removed, getting some sort of like automated valuation, or having them actually do an appraisal. But if there's a lot of equity fairly soon and you don't mind paying for the loan costs, you can always refinance. And the only caveat there is like rates would have to have gone lower, at least stayed the same, right? Because you wouldn't refinance from a 3% with MI to a 3.25% without MI. It just wouldn't pencil. But if maybe you closed on it, and I might encourage you to take a slightly higher interest rate if you're planning on refinancing in the future, because you're not going to stay in that loan for that long. The higher interest rate might get you some credit back, so you have more money in your pocket, where you refinance 6, 9, 12 months down the road, even 18 months down the road, then you lower the rate, remove the PMI. Jason, thanks for joining us. When rate quotes are within 1/8 of each other on a refinance, what scenario would make it worth going for the higher rate? Both have no lender costs. One is the current lender, higher rate. If it's exactly the same as far as fees go, then I guess I would have to look at the two lenders, right? If one's the current lender and they're great and they've always been great, and the eighth lower is like better.com and they might take 2.5 months to close it, then you can do some fun math. Like, if I pay an extra month in this higher interest rate because I'm waiting for this crappy online lender to close this loan for 2.5 months, then I'm paying an extra $582 in interest. And then, they're saving me $6 a month. It's going to take me 90 months to break even. Then maybe you just take the eighth higher current lender, close it fast. Everything's good and easy. But if it's like apples to apples on the quality of the lender and the speed in which they can close, but one's, an eighth better than the other, then you go with the better rate. But there's some value in closing quicker and having an easier loan process. I'm, trying to find the best deal in some things in my life. And, with mortgage, you obviously want to find a great deal. But if it's a few $100s difference, or it's $7 a month on an eighth of an interest rate, and you've got somebody who you like and trust, knows going to do a good job, versus some unknown, I probably stick with the person you like and trust. My contract shows closing on August 15th because seller has to get suitable housing. He found housing. Can I close sooner than August 15th? Sure. And this happens all the time, where there's a close date and then it gets adjusted. You contact your agent and say, hi, agent, will you send a message to other agent and see if everyone's cool with closing early? I'd like to do it on July 25th. And then if they've already found suitable housing, they're more than likely going to be okay with that and agree with moving that closing date up. That it works the opposite way, where can't close because this reason or that reason. We need an extra 2 weeks. Can we close on August 30th instead of the 15th? Closing dates get moved more often than you would think. And it's literally an addendum. One agent sends the other, amending the close date from August 15th to July 25th. And so, depending on their timeline and when they're moving and all that, for sure, it doesn't hurt to ask, right? Christopher Nunez, thanks for joining. I've kept my W-2 low. I own my own business to avoid extra taxes. Everybody does. And it's probably perfectly legal because accountants are like, hey, on your business, you can deduct this, you can deduct that, you can deduct this, and voila, your bottom line is 32 grand. So you have 250 in your business account. Well, you can use this towards closing, but what you can't do is all of a sudden double your W-2 payment. You're paying yourself $5,000 a month, and then in the next 2 months, you're going to pay yourself 10 grand. The lender's inevitably going to get a year to date, and they're going to get a year to date at the end of July that says 40,000 year to date. And you show that your payroll's, your W-2 is 10K a month. They're like, wait, we're 6 months in and it says 40K year to date. This should be 60. Why is it off? It's because you paid yourself less during the beginning of the year. You only paid yourself 5K. So, especially in this case. And if it was you paying your son a W-2 and your son was trying to get a loan, the lender goes, oh, pops up to your W-2 just a month ago. We're supposed to believe that your income doubled because you want to get approved for a loan. It's just not going to fly because lenders looking at 2019 W-2s, 2020 W-2s, 2021 year to date. So it might take some more planning ahead to do that, Chris. I mean, that's the honest truth. As much as I'd love to tell you otherwise, that's just the truth. Is that it's highly dependent on what shows up on your taxes. If you're paying less taxes because you've got a great accountant who can write the legitimate write-offs, the bottom line of your business, plus the W-2, you'll have W-2 income. And then if you're an S corp or something, you'll have K1s and, you'll be able to add the two of those together. You've got some pass-through income and you've got your W-2 income, but you can't double the W-2 and then 2 months later get a loan for it. Just unfortunately not going to work. Our problem isn't the insane prices. It's our insurance is off the charts. Unless you meet all the new building codes, 5K a year. Is that because like hurricanes and stuff? That's the thing too. People are like, oh yeah, Florida, you can get a house for 200 grand, 250 grand. But yeah, $5,000 a year in homeowners insurance is crazy. All right. Mona's got a 2-part question. Let's check it out. Thanks for joining, Mona. I appreciate your support. Joint bank account, only one spouse is loan applicant, and only the applicant's income deposits to this account. Credit cards belong to non-applicant, shows as a payment on the bank statement. How will underwriting view these non-applicant's credit card payments that do not belong to applicant nor appear on applicant's credit report? Great question. First, you've got the joint bank account and one person's on the loan, the other person's not. The person who's not on the loan is going to provide a letter saying that our borrower has 100% access to those funds in that account. That's first, because we want to know that it's not something where like, it's a joint account and they only have access to 50%. Most people who share bank accounts, like it's a given. They've got access to 100% of it. There's no limit on what they can do. With this payment coming out that's not theirs, the lender, generally speaking, is looking at bank accounts and saying, what is this payment? And in that case, you just write a letter of explanation. This is the joint owner of this bank account's credit card payment that they pay. It's a debt that's theirs and not mine. Totally okay. Not going to be an issue. If I was working for the Men's Warehouse, I'd guarantee it. Is that who guarantees it? Or we used to guarantee it? The Men's Warehouse? I'm getting old. My brain's getting mushy. Uh-oh. The Northerners coming down, paying cash for everything. Who are the Northerners for you guys in Florida? Is that like New York, New Jersey, those folks coming down? Are they the Northerners or is it Canadians? I'm seriously asking that question. I don't know. I think we set a new record with 56 people, live viewers. My goal is to get that to 100. Let's get 100 live viewers in the next couple Mondays. That would be cool. My buddy Kyle Seagraves, Win the House You Love. I'm going to be We're doing a live together on his channel on Wednesday. I bet we get like 200 or 300 because he's got a big base of fanaticos that follow his channel. He does good stuff. Win the House You Love, Kyle Seagraves. Check him out. I checked the new AMI for my area, OKC in Oklahoma. It went down? Oh, shoot. Joey, you were banking on it going up. You guys were all excited. That's why I told you, man. Just home ready, home possible. Besides the fact that it's not that big of a difference for the mortgage, just yeah, you were banking on it, man. And it went down on you instead of up. Oh, that's funny. That's funny, dude. Yep. See, you told me I should stop worrying so much about home possible qualifying. See, just listen to me, bro. I got you. That's crazy. I wonder if other areas went up. Hey, don't talk too much smack about California. We pay a sunshine tax out here. I actually, besides the horrendous tax and the crappy government, like I'm in a cool spot in Sacramento. I'm halfway between Lake Tahoe and the beautiful mountains, halfway between the coast. California is blank. I wonder what that means. Poor California. I'm still a fan. I'm sorry. California grown. That used to be my handle when I played poker online. It was CA_grown. Over the past 12 months, we've seen 28% fewer sales under 400 and 116% more over 750. Yeah, I mean, I think that's like when we talk about 28 fewer under 400, Ryan, I agree that like you can look at the under 200K sales and there's just none because there is none because prices have appreciated enough to where there's just no things for sale that are worth less than 200 essentially, right? Probably a few. And then, yeah, part of it on the higher end, 116% increase in homes over 750. You know, some of this, the entry level for a lot of Sacramento areas is like 4 to 6. And then that next, you know, nicer home, but not luxury is probably 6 to 9. But to your point, like, you know, that 750 right now is a house that was 600 2 years ago. Something to that effect, right? So more homes are increasing in value. Buyers are moving up. And that move up got to 750 plus pretty quick. Okay. The next county, Port St. Lucie County. That's where all the foreclosures are at. All right, we'll have to check it out. All right, here's one I like. Thanks for joining. I love talking about rental property. Plan to purchase a rental. Is it possible to get a much higher loan amount? Currently, I have 30% ready for a 280 to 300K property. So hoping to get a loan amount of 180K with a 780 credit score. Yeah, I mean, buying a rental and qualifying for an investment property is very similar to buying your primary in that it's a debt to income ratio. It's a math thing. And I've probably explained it on here before, but for anybody who missed it or is curious, if we're buying a rental property, and for some reason when I talk, I've got to write on paper, so forgive me for looking down, but it helps my brain think. For simple math, you've got $10,000 in income. Your current primary residence is $3,000 a month. You're going to buy a rental property. That payment's going to be $1,500 a month. You've got 2 car payments that are both $350 and 1 credit card payment, $200 a month minimum. So all that stuff combined, primary, investment property, car, credit card. What's that? 5,400 on the debt side, 10,000 on the income side. Good news is that 10,000 or 5,400 is 54%. Too high of a DTI, would not qualify. Good news, projected rental income, that place you're buying is going to rent for $2,000. So we can use 75% of it. So we can use $1,500 towards qualifying. And now you've got $11,500 on the income side. Times that by 45%. Oh, you still don't qualify. Sorry. Probably going to want to be under 45%. So in this case, like 5175 is where you want your total payments to be under, given that scenario. And right now we're at 5,400. You know, we just found out you only got 9 payments left on one of those cars. If you got less than 10 payments on a installment loan, like a car, we can omit it. So we just omitted that. Now we got 50-50 in payments. Your back end ratio is now only 44-ish%. You qualify. Congrats. You're good to go. That's how it works. I wish I would have been able to do a visual. I'm just going to get better in so many ways. I'm going to be able to provide visuals up here and write stuff like right here. I just have to learn technology. Technology and me. I don't know. I played G.I. Joes in the dirt in the 80s. Don't have the technology skills that these young whippersnappers have. $760 is best rates and terms. $720 get best rates for low down payment programs. Now you still want $760. There's going to be a $720, a $740, and a $760 most of the time, Joey. And they're not going to be huge, but it's going to be enough. Let me check for you. You want me to check? You want me to do some pricing? Some live pricing with Math and Mortgage Guy? I like this. Joey. Everybody should be able to benefit from this. So let's call it a 720 credit score. And you said low down payment. So buying for $400,000 and 3% down. And you got a 720 credit score. I'm just confirming on my end that my thought is correct. So click first time home buyer. Since you're not going to qualify for Home Possible, Home Ready, you're above that AMI. You got to go with a standard 3% down. I got to click the first time home buyer. So about 3 1/8 is what your rate is going to be at a 720. Let's see where you're at with a 740. 3 1/8, guys, is 3.125. 740, 3% down. Let's see where we land there. Almost 3%. Yeah, pretty close. 3% is a small cost. So we got better by almost 1/8, going from 720 to 740. Let's see if we get better at 760. This is fun, Joey. You learn, I learn, everybody else learns. Nope. 740 and 760 were the same. So 740 is the magic number. 3% down. See, I learned something new. Okay, everyone hit the likes. That's what I'm talking about. Hit the likes button. Man, I think the AC went off in my office. It's hot. Everyone's like, why do you always wear long sleeves? Because my office is always so freezing cold. It's hot now. What should I do if I can't finish my trial period plan for a mod? Can't get evicted, right? Well, if there's eviction moratoriums, or you're talking about foreclosure moratoriums, if you've got a modification that's like a good deal, I wouldn't want to screw it up. But I guess I'd have to know the whole scenario. You know, if you're having trouble making payments because you're not working, or if you're having trouble for whatever reason. But I mean, I have a hard time ever recommending somebody doesn't pay their mortgage. One, it will be like 12 months sometimes before you can refinance if you have a 30-day or 60-day late on your mortgage. So that hurts you there. It's going to just kill your credit. And so unless there's absolutely no other option, I would try to make good on your mortgage payment. Offer accepted, got a commitment letter, waiting for appraisal. What should I be worried about? Well, I wouldn't be worried about much. If you got a good lender who's doing a good job, I'd just be worried about making sure that you check in. If the lender needs any updated docs from you, get them to you. If the agent needs anything signed from you. Because that's the thing, like once you get into contract, people don't realize you got the title company, you got the real estate agent, you got the mortgage person, all asking for docs. And I've got busy clients, so I feel for them, working full time, going to school, got families and kids. And then they've got, me and my team reaching out to them, their real estate agent reaching out to them, the title company reaching out to them. It's a lot of stuff going on. So make sure that you're paying attention to any requests that are coming to you on your end, because sometimes I think people forget. I'm like, hey, you're buying a $500,000 house, by the way. So the bank statements we asked for 3 days ago, you should probably get those to us. That's my best advice, but don't be worried. Everything's good. If you got a good lender, you're in good hands. Good agent, good hands. All right. Hit the likes. Hit the likes. I like that. I'm going to use that. I'm stealing that. Hit the likes. Yeah. I mean, if you're VA eligible, then for sure use that. Like 0% down, no mortgage insurance. It's a really good looking loan. And if you got the eligibility, it means you served our country, you deserve it. So talk to a lender who's knowledgeable at VA. If you don't have one, I'll give you a great one to talk to. Where'd it go? GreatMortgageBroker.com. If you don't have a lender and you're looking for a great mortgage broker in the state you're in, 6 questions on this GreatMortgageBroker.com website I've set up, where it's my beautiful face and a video, and I'm connecting you with someone who I guarantee is going to take good care of you if you don't. Recently, I had somebody reach out and say, hey, I filled out the form and no one reached out to me. It was coming from a Philly number or something, so they didn't recognize it. But they're going to reach out to you. They're going to try to assist you if they can assist you. They're going to give you good advice. But what they're not going to do is burn you or not give you great service, because then I'm going to cut them off. So greatmortgagebroker.com. Check it out. All right. In contract, price was reduced $20,000 because a foundation repair is needed. If appraisal also comes in lower. All right. LB Alexander. I don't always give people the news they want to hear, but I give them the truth. Foundation is a big deal. And the appraiser, if they're any good, is going to call out the foundation issue. And if they do call out the foundation issue, the lender is going to say, stop, do not pass go, do not collect $200. We will not fund this loan until this issue is corrected. So the seller is going to either have to go in there and fix that foundation issue in order to close the loan, or if they back out of contract, you can have your realtor let them know, listen, if you don't fix this foundation issue, no one's getting financing on this. And that's the truth of the matter. I had one where there was a clear foundation issue and the seller put these big rugs in the garage and then put duct tape on them so that like you couldn't take them off the ground. They were like, basically like the garage was covered in big carpets that were duct taped to the floor. And the appraiser said, I'm going to see what's under these carpets. He was curious. And under these carpets was big old cracks. There were some foundation issues. And basically the appraiser notes that, takes pictures of that, and makes the appraisal subject to that stuff being repaired. Nothing's happening. No lender is going to finance that with any serious foundation repairs. So this might be a deal where you back out, or it might be a deal where you say, hey, we can stay in contract, but you're going to take 6 weeks probably to fix this. And then when you do fix it, then we're going to play ball. And they might want you to pay the full $250. But I don't see it if you guys already discuss that and it's a big enough deal where they're giving you a $20,000 credit. I would guess appraiser's going to call it out. You can show it in your stocks, investment account, different things like that, because reserves, for anybody who doesn't know, is not necessarily like money that you're bringing to close. But if you own investment properties, you're buying an investment property, the lender's going to ask for reserve funds, meaning your payment's $2,000 a month. We want to see 6 months in reserves on this investment property. So we want $12,000 in an account. In the case that the world crumbles, you can use a stock account, investment account, a separate account that's not for this transaction, anything like that to show reserves. All right, I'm getting $100K in SBA loans soon. If I run that through payroll retroactively, can that satisfy my income verification? So I'm guessing you're the business owner and you're going to pay yourself a W-2 salary. Having just payroll for this year isn't going to help you if you're self-employed. They're looking at 2019, 2020, and year to date. And so if that's... Do some follow-up with some clarification, because it sounds like it might be either a new business or something where you haven't paid yourself in the past and you're just going to start. If that's the case, then it's a no-go. The need to repair shift in your favor, because they're not going to close without those things being repaired. And honestly, if I was you, I wouldn't want to close on it without those things being repaired. What if it's a $40,000? Foundation stuff can get expensive, and everything's more expensive right now. Concrete's more expensive. Steel's more expensive. Wood's more expensive. Life is more expensive right now. So $20,000 is like a tank of gas and a lunch. So I would cross my fingers the appraiser does call it out, and that you either say, I'm backing out or you're fixing it, one of the two. And they might not want to fix it. But if they don't want to fix it, here's the thing, is that the agent can tell them, go spend 40 grand, or list it to only a cash buyer is the only one that can buy it, and you get a cash buyer to come offer you 180. Your choice. Let me know. Does it matter when the lender checks credit at closing? I have additional $1K in debt because I didn't pay it in full like I usually do. They're checking new credit lines, debt balances. And so, yeah, I mean, I'm not going to say this is for sure is going to affect it, but I probably, well, if it's an existing credit line, where your balance is $2,400 instead of $1,400, it might not affect it, right? Because at $1,400 balance, or I guess you're saying you usually pay it in full. This month you just have $1,000 balance. Even if you pay it in full, it probably shows up as a $25 minimum payment for on your report. So it's likely not going to affect you. I don't think so. I think you're fine. Shop around. Loan Depot's not the worst, but a local mortgage broker probably help you out. That's my 2 cents. Can we legally rent out our primary residence after buying? Well, depend if you buy it and then rent it out right away, that's not very honest. Has it ever happened? Yeah. So, I mean, I guess depends on how quick the turnaround is. Close on Friday, rent out Monday. That's not a good look. I wouldn't do that. Close in June, start renting out January 2022 because you decide to move. I think you'll be fine. Again, my 2 cents. I'm just some guy on YouTube. How much is rental income calculated for a mortgage if the rentals own 50, partner, tenant in common? Is it an even 50% of income and expenses? I heard PITI is not split. refer to your taxes. Schedule E on your taxes, real estate owned, however you're having it show up on your taxes, where it might be showing up the whole kit and caboodle on one of your taxes and not on the other. But that's what the lenders are looking at. They're looking at your Schedule E. I put down $40,000 in escrow. Once that is released, does it pay down payment, closing, and attorney fees? Oh, for sure. You're talking about your earnest money deposit. That's a big one. That's a healthy one. But if you're putting down $100,000 plus closing costs, so your total is $110,000 cash to close, that $40,000 gets applied to that, to where at the end of the transaction, you're going to have $70,000 due. That's exactly where it's going. It's going towards the down payment plus closing costs. Oh, I crushed it. The northerners that you were referring to are New York and New Jersey. Good question, Richard. I got this asked today. I had a buddy of mine, a past client, who reached out and was asking about someone who's brand new. And it's hard because I think what's most important when you're new, as a mortgage loan officer, is you just want to get a lot of deals in front of your face. And sometimes the best place for a loan officer who's experienced and, seasoned might be the broker channel. I'm working as a broker. I can send loans to 50 or 60 different banks. I've got what I consider, the best product line, the best pricing, the best speed, the best service, because I can choose. But that might not be the best place for someone who's brand new, because they're not going to have the same amount of support, not the same amount of, structure. Some of the direct lenders have structure, and they've got corporate marketing, they've got corporate compliance, they've got corporate processing where they can help you, and you can submit underwriting scenarios to a scenario department, and they're going to answer your questions there. And so for a new MLO, I think my best advice is get around people that are doing it at a high level, regardless of where you're at. And like some of my broker counterparts would probably shame me for saying this, but if I was brand new, I might start at a bank or a direct lender where I could just be plugged into systems and maybe even part of like a team that's doing a lot of business. And that way I can just look and see and touch and feel deal after deal after deal, because there's no replacement for seeing a lot of deals. And I think that in the position that I'm in now, where we've got a lot of deals in process, a lot of deals funding every month, that's where you learn. You don't learn from like picking up a manual and being like, okay, what the mortgage guidelines say about this is that. You just have to see, it's the commercial that says that we know a thing or two because we've seen a thing or two. Like I see something new every single day. And with 55 or 60 loans in process, every day is a new day for learning something new. And there's so many variables in real estate and mortgage that I just don't know what tomorrow is going to bring. Tomorrow there's going to be a new problem I haven't seen. I'm not talking to you, Apple Watch. But yeah, so just be around a lot of deals to learn. And then after you've got a certain amount of knowledge base, whether that's 12 months or 18 months or 24 months, then you look around and go, okay, where's the best place for me and my business model and how I'm going to operate my business? Where do I fit the best? Because there's so many different ways to do this business. You're essentially a self-employed entrepreneur who is 100% commission at most places you go. And you want it that way because you want an unlimited ceiling. You want to be able to go out there and say, the harder I work, the more I serve people, the more I'm going to make. If I do a crummy job and I'm not adding any value, I'm not getting paid anything. If your mindset is different than that and you just want to have some sort of salary, then for sure you go to a bank. But if you're looking for serving at a high level, doing a lot of business and making a career of this, then you're going to seek the channel that provides you with what you feel is best for the clients. Because I think that if I didn't believe that the broker channel was the best for the consumer, I wouldn't be selling myself and my business as much as I am, saying, listen, I can help you out and I can offer you the best speed, the best service, the best terms, the best rates. Coming to me, I'm happy to help. So that's my long-winded 2 cents. It might have been 9 or 10 cents. All right. I'm glad you're learning new stuff. That's the name of the game. You learn, I learn, we all learn. Post a link for the show you'll be on. Look up Jason Walter on YouTube. Subscribe to him, and it's just going to be on his channel. He's a Sacramento real estate agent. He's got some good stuff. So I'm going to be on his, and then maybe I should post a link to Win the House You Love. Let's see if he's got Win the House You Love, because I'm on his on Wednesday too. We'll see if he's got something up yet for coming soon. Where? Oh, videos. Upcoming videos, past live streams. I don't know how YouTube works, guys, but I couldn't find it. Win the House You Love. We're going live on Wednesday. And then Jason Walter, he's going to put out a video on Wednesday. I'll be on both of those, talking good stuff. Hey, no problem, Mona. Happy to help. 32K salary. Oh, you're talking about $180,000 investment property loan. Do you own a primary, or is this your first loan? If you own a primary, we're factoring in more stuff. Your primary mortgage and all that there. Average income you're seeing for a $450,000 to $500,000 home. I think what you're asking, this is me assuming, is not necessarily that you're wanting to know how much it takes to qualify, but what income is buying a house for this amount. And I would say where I'm at, that's like $100,000 to $125,000 a year. Those people that are making six figures are buying $450,000 to $500,000. Maybe some people that are $80K. And here's the thing: if you're $80,000 a year with zero debt, buying for $500,000, you're probably better off than somebody who's $125K a year in income, but has tons of student loans, 2 car payments, and other debts, right? So this is kind of a multifaceted question, but you'd qualify for something like that. Again, you got to assume some variables, like 5% down, 10%, 20%. Let's say you're putting 10% down, buying 500,000. You'd qualify likely with $7,500 a month. 90 grand, even less than that actually. You could make 80 grand and qualify for that if you didn't have a ton of debt. But probably to answer your question, that's my 80 to 120 a year folks that are buying, because that's an entry level house in the markets that I'm kind of working in. Colorado in the house. What's up, Colorado? All right, Victoria from Santa Barbara. Victoria, you don't know about 10% down jumbo? You gotta give me a ring. I made at least 2 videos on it. Because in Santa Barbara, you can go up to 822, 375. True that you can't buy anything for that price, but all the stuff I'm doing in San Jose, all the stuff I'm doing in San Francisco, all the stuff I'm doing in San Diego, all the stuff I'm doing in LA County, it's all 10% down jumbo. It's the coolest program. No mortgage insurance, 10% down jumbo. It's a unique program, and it's for people like you. You need to go to Matt the Mortgage Guy on YouTube. You need to type in 10% down jumbo. 10% down jumbo. Oh, check that out. If you type in 10% down jumbo, the first 2 videos on YouTube are me. One of them is me being interviewed by One Rental at a Time, my buddy Mike Zuber. The second one says jumbo loans are back. This product came out in March of 2021, March 17th, I believe, on St. Patrick's Day. So it's your lucky day, Victoria. Yeah, so give me a call. This is a good one. This is a good one for people who are buying $1 million to $1.3 million, and they're saying, listen, 20% down plus closing costs, plus reserves, plus an appraisal gap. I don't have that type of money in the bank. So if I can put down 10%, I can do it. Guess what? You can. So that's that. Joey, I got you, man. I like doing it. I mean, what's there to hide? I'm just not going to ever be the flyer you get in the mail. 2.25% in fine print costs you 3 points. I'm giving you the par rate all day, where you're not paying any points. The rate that actually you're going to get into, right? And I'm just pricing it and showing you. All right, Laren, I'm finding some condos in New York. They're going for $100K on Zillow. Outside of the Bronx area. Is that too good to be true? They're 1 bedroom. If anybody here knows anything about New York, I'm sure you can chime in and you know more than me. My buddy Ben Lavender, he's out in New York. He's a great broker. He could help you out. God, he used to make cool YouTube videos. He got a cool British accent. I wonder if Ben Lavender is still on YouTube. Ben Lavender. I'm going to give him some crap. He should still be making videos. There he goes. Ben Lavender Mortgage. Oh, he's still making videos. Give him a follow. Ben Lavender Mortgage. Lavender. Your British mortgage broker. Only 1 video in the last 30 days. He's got to make some more of these things. But yeah, he can tell you about New York. I don't know. Go on his channel, put some comments in one of his loans. Say, Matt the mortgage guy told me to reach out to you. I'm curious about this. That'd be cool. Ben's my guy. He's a cool dude. Are refinance rates higher or the same? 806 credit score, 281. Loan estimate was 3.134. That sounds about right. They're higher than they were last week. If what's the value of your home? Without even pricing it, I'm telling you that's probably right. If your home is worth 400-ish, that should be right. If your home is worth 600, that sounds a little bit high. Scenario. Hopefully you're working with the mortgage broker. Let's see, 281. Say the home's worth 450. 475. Refinance. Rate and term. And is it a rate and term? Show you guys how we price things around here. Joey knows it. Yeah, it's about right. I mean, it's a little bit higher than what your buddy Matt the mortgage guy might give you, but not bad for those other guys. I'm zooming in on it for you. 3.005 is what I got over here in my neck of the woods. Tell me what. Share screen. Boom. I guess let me take this down. Take that down too. Banners. 3.005, 0 points. 2.99, 76 bucks. 2.875, about a half a point, 1,500. 2.75, more than a point. So like the sweet spot, I mean, 299, pay 75 bucks. 3.13. It's about that. I'm like $1,000 credit. So it's about the same, right? So they're pretty close. And really, truth be told, your pricing is going to vary based on zip code. So if they're another zip code, long story short, that's good. If it's a rate and term and your home is worth, yeah, I mean, really, you're in good shape. That's 3.13 is about right. You're still asking about Home Possible, bro? Leave it alone. You got to focus on finding a deal. All this energy that you're spending looking at Home Possible and different scenarios and all this, if you spent the same amount of energy, Joey, going out there finding deals, you'll be finding yourself a killer deal that, regardless of the program, would be a good long-term investment. But you're too busy worrying about Home Possible, Home Ready. That's okay. Still got love for you. All right, 59.2 annually. If her new job is salary, and you're not going to like this answer, full-time, full pay salary, like they're going to use that salary. So yeah, they're going to use that new one. So you're still trying to squeeze into Home Possible. Not going to happen, dude. Sorry. 2 hoes and a console. You're going to have to tell us all backstory behind that screen name, by the way. One of these days, we're going to open up. Do you see sellers accepting backup offers in this market? Mostly seeing pending or contingent. Would reaching out to neighbors in the area asking to sell. I mean, you could have your agent put something out in the neighborhood saying, we're looking for a home in this neighborhood. Anybody want to sell? And that agent can offer him something like, I'll represent you and I've got a buyer. And instead of charging you 6%, where it's 3% on both sides, I'm only going to charge you 4.5 or 5 because I'm going to represent both sides. Could be a strategy. But I'm getting tired. I got about 15 minutes left of me, folks. So fire away. All right, we got that. We just don't know if that's your only home loan, if you've got other debt. If that's all you've got is that one rental, $180K loan, and we got to know about the taxes and insurance. It's going to be close. 32K is what, like $2,700 a month-ish? This is a great question. Great question. Lender decided to waive appraisal without me asking. Here's what happens. The lender did not waive the appraisal. The appraisal waiver versus appraisal. Let me see. Appraisal waiver. What's the difference between appraisal waiver and appraisal contingency? So if you waived the appraisal contingency, meaning it doesn't matter what it appraises at, you're going to pay that amount. That's one thing. If a lender gets your loan and you're putting down 25%, the lender plugs everything into their system and says, based on everything we see in the system, we do not need an appraisal. We're cool. We're cool with using this value. And I'm going to put up this link. I don't know if you can copy and paste this. Maybe you can't copy and paste this. So maybe I should put it in the comments. But it's a video I made, which is a really good video. YouTube didn't push it that much because YouTube they like the clickbait more than they like the good quality info. But I basically go into the difference between an appraisal waiver and waiving your appraisal contingency. Appraisal waiver by the lender is a great thing. It basically means they're confident in the value and they're not requiring an appraisal. Saves you $500. It's a good thing. Some people are like, wait, what's going on? That's weird. Trust me, it's a good thing. Yeah, see, this is where you're going to got, Charlie, to be completely honest. I don't want to rain on anyone's parade, but I'm all about straightforward and honest truth. 2020 was a down year. By down, is it zero? Is it negative? COVID shut you down for a year. Yeah, so it's going to be tough. you're probably, if you've been in business for more than 5 years, what you're going to want to do is show a great 2021 and then apply in 2022 after 2021 taxes have been filed. So if you've been in business for more than 5 years, you can use just the last year and you don't have to show 2 years. If you've been in business for less than 5 years, or you show a lender 2 years as self-employed, they're going to average those two. And so if you've got 2020 that's negative or break even or 10,000 in revenue, and then you've got 2021 that's 100,000 in revenue, they'll average the 2 years and you'll only show 4,000 a month. And so that's my best advice, knowing what I know. Have an excellent 2021, crush it on paper, and then file 21 taxes in 2022 and apply then. Tell your lender that you've been in business for more than 5 years. You can prove it, and you just want to use the 2021 income. Hopefully that'll be enough to qualify. Oh my gosh. No. When I don't know if anyone's seen that TikTok, but it's funny, where she says, would you rather use a great quality would you rather use A, better mortgage, or B, and then before you spit it out, B, 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 B. I don't know. I shouldn't hate on better. Besides the fact that I've heard a bunch of bad stuff about their CEO, and I've heard a bunch of people having bad experiences. Besides that, they're probably fine. Don't use them. Yeah, the appraisal, Susan, calls out issues with the house. The inspector is doing like a thorough job, where they'll call out like a light switch is clicking and not working like perfectly. And they'll call out the fact that there's a dent in the baseboard. I mean, they're writing a 116-page report, pushing all liability off them, being like, no, I told you, look on page 87. I told you that this happened. The good thing about the inspection report is if you're not a hypochondriac and you can act hypochondriac, is that the word? And you can read it and say, okay, on the first 2 pages, they put these are the big issues, like must check the AC system. That thing is on its last leg, probably going to die. You need to have a roof inspection done. I saw that the roof was in bad shape. I didn't go any further than that, other than tell you need to use a roofer to get a roofing inspection. And then it's a bunch of small stuff for 116 pages. Check the AC, check the roof. You know, if you're spending $600,000, spend a few hundred to get those inspections. But then, you know, apart from that, they're going to go into detail on 1,000 things. The appraiser is coming out and they're only really going to call out like really visibly like foundation stuff if it's super obvious, if the roof is in disrepair and it's super obvious, if the ceilings are falling down and there's wet spots, super obvious, right? So they're both calling out problems. The inspector is going into real detail, and generally the lender is not looking at that report. It's just for the buyer's own personal use. And then if the appraiser calls out stuff, the lender's looking at that and going, yeah, they called out the roof. We need a roof cert, or we're not going to close this loan. Then, you know, the buyer tells the seller, we need a 2-year roof cert, or we can't close this deal. They got to go get a certification saying the roof's got at least 2 years of usable life left in it. Okay, your inspector found the issues. Well, I think the least of your issues is if he lowers it because of the foundation, because the appraiser's not going to lower it because of the foundation, but if he calls out the foundation, it has to be fixed or they won't do a loan. So if they lower it because of the foundation and the price gets lowered to 220, then you just tell the guy, listen, you can't afford repairs. A cash buyer is not going to pay you 220. I will. Let's close. But it's very unlikely that it's very, very, very unlikely that they say, oh, only worth 215 because there's a few little crackies here. They're going to say like foundation issue, beware, red flag, run. I mean, they're working on behalf of the lender to protect the lender. So if foundation is an issue and they call it out, they're not calling it out and not having it repaired. So they either just miss it and it's not obvious to the common eye, and the appraiser's, late to his next meeting and on an empty stomach and hungry and thinking about like double decker, where double deckers at? Lost my train of thought. That's what the appraiser would do. Lose his train of thought, miss the foundation issue, and just bring it in at $240,000. If that happens and you're comfortable closing, knowing that you're going to make the foundation repairs yourself, all good. Make sure it's only $17,000 is my only piece of advice. And you're welcome. That's why I do it every Monday at 6:00 until I get too old and tired. And I'm getting close, I think. Just having a lot of fun, just answering people's questions, just being a man of the people. Who orders the appraiser? So, okay, John, you're the buyer. You get into contract. Your initial disclosures come out. You sign them. Once you sign your initial disclosures, we order an appraisal. We send you a link. You pay for it. The appraisal management company assigns an appraiser. That appraiser contacts the listing agent and says, "Hey, listing agent, when can we come out and get access to the home to do the appraisal?" They schedule it. The appraiser comes out, brings back the report. It's your report. You paid for it. It's not very common that a buyer shows up. Sometimes I've seen it where the buying agent shows up. So maybe you ask your agent to show up. You're not wanting shady things, which I wouldn't worry about. Shady stuff is not happening in 2021. The listing agent, if they could have more control over appraisers, they certainly would. They can't. And in this market, it's super competitive. It's not very often where appraisals are coming in at value because of any influence by the listing agent. It's more like they're coming in below value. And the listing agent's like, "Oh my God, this thing is worth way more. He didn't even take into consideration these beautiful finishes that my sellers did. That's worth at least $30,000. These beautiful floors and this, unfinished basement, whatever, So I wouldn't worry about it, but that's how they work. Yeah, this is a good question. And this is one where you type in builders, lender, math and mortgage guy, and you find a video I made where I basically said, look at the loan estimate from the builder plus their incentives, then reach out to a broker who you like and trust. I must have looked at 50 or 60 scenarios last year, and it was probably 50-50. Some of them were a rate and a $2,500 credit where I said, listen, I can get you that same rate and a $5,500 credit. So their lender credit that they're offering you for using their preferred lender is not much of a credit at all, because I'm able to get you that same rate with a $5,500 credit or a lower rate with a $2,500 credit. That was half of the time. Half the time was like early 2020. Builders were giving $7,500 credits, $6,000 credits. And then I was looking at it going, listen, I know you like me more than you like the builder's lender, but use them because they're a better deal right now. And you can like me all you want, but don't like me $4,500 worth more. So it depends. It depends on the builder. It depends on the incentive. Run it by a broker who you trust, who's going to give you honest feedback. Because here's what I do. I give you honest feedback. And if I tell you to use the builder's lender because it's better for you, guess what happens? Your next loan, you come to me. Your sister, she calls me. Your cousin calls me. I get 10 deals out of it instead of one. That's why I give you the honest truth. That's how you build a big business over the long term. You play the long game. And that's what I do all day, every day. 60 to 70. The good news is I get to, as a business owner, structure those 60 or 70 hours to work life in between, right? My kiddos' 6th grade graduation, I was there. My kiddos' Sly Park trip last Thursday, I was there. Baseball practice, coaching my kids baseball, all that stuff. I'm always there. Does it mean that sometimes I'm working till 1 a.m? Yes. Does it mean sometimes that I've got to take calls and do stuff on a Sunday afternoon? Yes. But I'm all in with the family when I'm all in. And then when I'm all in on work, a day like today, where I'm working 13 hours, all in. And yeah, I'm working towards getting down to 50. I freaking like it though. I really do. And now that I'm building the team where I can do some of the fun stuff, some of the business building, moving some chess pieces. You're going to be great in this position, helping these clients. We're going to do follow up this way, and different teammates that are just great people in positions where they can really serve people at a high level. I got to tell you, we are on our way to building something huge. Probably do 125 million in mortgage this year, and it's because of what an awesome team I have, and that's what makes it fun. Is every day reviews that come in. You guys were great. Thank you so much. You made the process so smooth, so easy, communicated so great. Really appreciate you. All that stuff that continues to give me the fuel I need to work 60 hours, be all in with my family, run 1,000 miles a year, and all the other stuff I'm trying to do. Because I'm a little bit busy, but I just don't spend any time on the unnecessary Netflix shows, stuff that just doesn't move the needle on me becoming a better human. You may break mortgage, but I break your mama's back. That was a good talk right there, Caden. I'm expecting I will need around $20,000 for my down payment closing costs. At what point in the process does that amount need to be shown in my bank? Probably before the pre-approval. I mean, it can kind of be a agreement between you and the lender, like, hey, if you're going to have 18,700 like we need for the transaction by this date, you're good. Or I can give you a pre-approval. Listen, this is contingent on this much money being there by this date. That's kind of a tricky game to play. So don't get too crazy with it. My rate was locked at 2.8%. Gave documents and received a commitment letter today, congratulating me. I actually don't know what a commitment letter is. We don't do commitment letters in California. But if you have a loan estimate and it shows locked, does it likely mean I get the loan? Unfortunately not. I've seen all too often lenders disclose when they don't have a full package, or they don't, you haven't got the loan approved yet. It hasn't even been submitted probably until you sign those initial disclosures. So my short answer is no, sorry. You gotta get it approved still. All right. This was the link for which video? Oh, appraisal waiver and appraisal contingency. In case anybody wanted to see that, because it's a good video. YouTube didn't agree, but whatever. They don't know. I've seen plenty of people do the verbal request over the phone. Every servicer is different, though. I had a lengthy conversation with a realtor today about this. And I don't know if you're talking about application for forbearance or the loan modification. I mean, I've seen it done so many different ways, Catherine, that I would say it's servicer dependent. I mean, some of them you click on your online account, it's like forbearance. I've had hardship. I'd like to enter forbearance. But maybe some of them now want an application. They want something in writing from you. I don't think there's anything illegal about that. Like they're forced to accept anything verbally. So yeah. Circle back with me. Let me know what they say. All right, Charlie. Thank you. I appreciate you asking the hard questions and taking the hard truth, because unfortunately you get so many people that are just going to try to tell you what you want to hear, and like weeks and weeks of stringing you along, all to be like, oh, sorry, man, like you can't get a loan for whatever reason. That doesn't serve you. It doesn't serve me. It doesn't help, with my time, energy, and resources of my team. And it certainly doesn't help, busy professional who's running his own business, being dragged along. You just got to crush 2021 and come back with a with a good looking tax return. Because self-employed, they're just going to look on your tax return. You could have $1 million in deposits. You could have 500,000 in the bank. They really just want to see how did he file his tax returns and what was his bottom line for his business. Theo, what's up? Good to see you. Good to see you back. I don't think 403B, is that like a, I think it's like a state, like alternative retirement plan. And I do not think you could show that for reserves when buying a rental. With you working 60, 70 hours, do you still qualify as a real estate professional? Good question. I don't file my taxes like that. And I haven't even talked to my CPA about whether or not I would benefit from that, because I've got the S Corp for my mortgage business. If I, filed as a real estate professional, there's other tax incentives for different stuff that I'm doing with real estate. Good question. I don't file that way, and I don't know if there would be any benefit to it. RE professional. I'll shoot my CPA. He still needs some stuff for my 2020 taxes. So when I send him that question, he's going to be like, where's the stuff I asked for? What is the end goal with all the real estate you procure over your lifetime? It's twofold. I think that some of it's going to be paid off. And so some of it's going to be producing cash flow so that when I'm 55 and I feel like flying to go visit my son and his family in Connecticut, wherever they're at, or maybe they're in California still, I don't know. I can take a month off, and I just, I'm not relying on income from a mortgage business, if that's still around, or anything else. I can, the freedom part of it for me is key. And, building generational wealth and passing down real estate certainly is a good feeling. I'm wrestling with that right now with trying to take a kid like me who came from nothing, had nothing given to him, and has incredible drive to go out and work hard and create. My wife being the same way, first generation in the States, my wife has that immigrant hustle, hardworking, appreciates the heck out of everything. I'm trying to instill that in my kids. And so, having them inherit a bunch of real estate, probably, well, by then they'll have learned, right? By the time they're 70, they'll have learned what they need to know about all that. But anyway, I went off on a tangent there. I guess it's twofold, right? It's generational wealth and passing some of that down to my kids and my grandkids. But then it's also freedom in retirement, where I'll have passive income from real estate, where if me and my wife want to go spend a month down in Mexico, she can see all the beautiful parts of Mexico I saw when I studied down there. We can, take Spanish classes together. We can, fly to Europe, see the beautiful Montenegro where her mom was born and all that stuff. That's the kind of stuff that I'm building real estate wealth for the freedom. Man, that was a cool question. It kind of got me thinking. I appreciate that. Do you know of companies doing bank statement loans for self-employed person? Yes, I do. Home Express. I think I've got one funding today. Depending on the program, you do 12 months of bank statements or 24 months of bank statements, 25% down. Rates are probably 5%ish, but they're out there, definitely out there. Angel, I'm looking to buy a new primary residence, but also want to get a HELOC on one of my rentals to buy more investments. Try to find a HELOC on investment property. And I'm not saying that to be a smart ass. I'm saying that because it's hard, and it's possible there are some out there. They're really hard to find. And so, what I might look at if I were you, if you're buying a new primary, depending on how much you're looking to put down, maybe you put less down on the primary and use some of that funds for investment properties. For instance, say you're buying something for 500 and you plan on putting 20% down. Instead of putting down 20%, if you got good credit, put down 5 on primary with 5% down. If you got good credit, the mortgage insurance is next to nothing. So, your payment's slightly higher, you pay some mortgage insurance, but you put down 25 instead of 100, take that extra 75, deploy that towards some rentals. That might be a plan. So an approval letter, commitment letter. So since you're helping me learn here, Tim, this is on a purchase or a refinance, and it's once you've already disclosed, right? Like you've got you're in contract. I mean, they're not giving you a commitment letter that commits to a certain rate. I'm prepared to make a loan to the borrower. What is a mortgage commitment letter? I just think this sounds cheesy. It's a pre-approval letter. Okay, it's a pre-approval letter. I just read it. We call it a pre-approval letter in California. Do you think Vegas's drought will affect home values? I mean, California is going to be in a drought again. The answer is no. Do I have some feminine qualities? When my wife uses a Snapchat filter, I think I kind of look feminine, but not a transgender. Thanks for asking. Yeah, Jason Walters is cool, man. He does good stuff. Yeah, I get you, Teddy. I still have, my golf every once in a while. I got a book club with other business owners where we read business books and get together and, barbecue, hang out, talk about the book for an hour or two. What happens when you're a super busy business owner working 50, 60 hours a week is you've got a busy business, you've got kids that are involved in activities, and like your hangout, your social time is when you hang out with the kids. You hang out with the kids and they're playing baseball, other baseball moms and dads. When you're hanging out with the kids and they're doing, a basketball league, you're talking to other parents in the basketball league. When your kids go to the pool where they swim at the, local cabana club, you're talking to parents there. And so that's your socialization. But yeah, you're definitely not spending time at bars or going on camping trips with your buddies over the weekend when you're building the business, working 60 hours a week, trying to be a good husband, good father, all that other stuff. So wouldn't trade it for the world. Enjoy it. Enjoy it a lot. And the business I'm building is fun. I talked to somebody today who was getting into mortgage and wanted to know how I like it and whatnot. And there's no better feeling. There's no better feeling than helping someone buy a house they didn't think they can buy, helping somebody refinance and stay in a home they thought they couldn't stay in because they couldn't afford the payment, helping somebody, move up to a bigger house because they've got 4 kids and they're cramped and they're busting at the seams in the current place they're in. So, yeah, good stuff, and it's worth it. All right, we're at the 2-hour mark. I'm about to roll, but I got to do one more. Know nothing about real estate. Does Home Express lend in Oregon or just California? $13K for down payment is going to be the biggest sticking point. Because even a $250,000 house, you're going to need 25,000 ish for a 3.5% down FHA plus closing costs. I can connect you with someone in Oregon. Shoot me an email, matt@mattthemortgageguy.com. I'll connect you with somebody in Oregon. All right. Inventory starting to increase here in Utah. And I know Utah's been hot. Utah was one of the hotter markets. They were going bonkers. So yeah, it's good to hear the inventory starting to increase. I appreciate everybody. I've had 2 hours. I'm tired. I've been mortgaging all day long. If you have any questions at all, if you're in California, matt@mattthemortgageguy.com. If you're outside of California, again, greatmortgagebroker.com. Quick 6 questions. You'll be connected with a broker who's in your state, because one of the questions is, what state are you in? I appreciate each and every one of you that took your time to join. Hopefully I added some value. Hopefully you'll be back next week. Let's, in the very near future, get to 100 people watching. At one point, we were in the 60s tonight. So we had something we were doing right, some sort of value we're adding where people joined it. I appreciate the heck out of all you guys, and I really enjoy this. So thanks for watching. Until next time.